In December 2024, a federal regulator finalized a rule that would have capped most overdraft fees at $5. If you've been waiting for that to kick in, it never did. In 2025, Congress voted to repeal it before it ever took effect. Banks and credit unions collected more than $12 billion in overdraft and non-sufficient funds fees that same year. The average overdraft fee today sits at just under $27, barely different from a year earlier, and still close to what you'd pay for a rideshare across town, charged for the crime of your balance dipping a few dollars negative. So this isn't a story about a fee that got fixed. It's a story about one that was scheduled to shrink, and didn't, in a year when almost every other part of consumer banking we've covered on this channel has moved in exactly one direction: toward the bank. Today we follow the money through overdraft, using data from the CFPB, court records, and public bank filings, sourced on screen the whole way through. Let's get into it. Pillar 1. The regulatory whiplash itself, because the timeline matters more than it usually does. For years, overdraft revenue had actually been falling, down nearly 50% industry-wide between 2020 and 2023, as public pressure and competition from fee-free challenger banks pushed traditional banks to add grace periods, low balance cushions, and in some cases eliminate the fee entirely. That decline happened before any binding rule forced it. Competition and reputation did that work on their own, without Congress or a regulator requiring a single bank to change anything. Then, in December 2024, the CFPB tried to lock in further, guaranteed savings, cap most large bank overdraft fees at $5. The amount the agency calculated actually covers a bank's cost of processing the transaction. Banks that could prove their actual costs ran higher were allowed to charge more. Everyone else would be capped. The rule was set to take effect in October 2025. It never got the chance. In early 2025, the Senate voted 52 to 48 to reverse it. The House followed, and the rule was dead before a single consumer saved a single dollar under it. And here's the part worth sitting with. Some banks had already started rolling back their own voluntary reforms once the regulatory pressure lifted. One regional bank cut its overdraft fee from $36 to $15 in anticipation of the rule, and then, after the repeal, raised it back to $20 and shrank its no-fee cushion from $50 to just $20. Meanwhile, one credit union that introduced overdraft fees for the first time in late 2023 saw its overdraft revenue jump 471% in just 2 years. The response wasn't uniform either. Smaller institutions with modest overdraft revenue actually increased that revenue by double digits over the same stretch that larger banks were cutting theirs, meaning the pullback that made headlines was concentrated at the biggest, most visible banks, while plenty of smaller ones quietly moved in the opposite direction. The lesson isn't that regulation never works. It's that voluntary progress, without a rule behind it, is genuinely reversible, and in this case it reversed. Pillar 2. How the fee actually gets multiplied through practices that have cost banks hundreds of millions of dollars in lawsuits and still aren't fully banned everywhere. The first is called transaction reordering. Here's the mechanism with real numbers. Say you have $100 in your checking account. Over one day, you make 5 separate $20 purchases, then one $50 purchase at the gas station that evening. If those transactions post in the order you actually made them, only the final $50 purchase overdraws the account. One overdraft fee, about $35. But for years, many banks didn't process transactions in the order they happened. They processed the largest transaction of the day first. Under that method, the $50 gas purchase clears first, immediately draining the account. And then 3 of your 5 small $20 purchases each trigger their own separate overdraft fee. Same 5 transactions, same starting balance, but instead of one $35 fee, you're charged 3 of them, roughly $105, for spending the exact same amount of money in the exact same day. That's not a bug in the system. For the banks that did this, it was the system. One single law firm's cases alone recovered more than $370 million for customers over transaction reordering practices, with individual settlements ranging from $2 million to $137.5 million. Bank of America separately settled a reordering-related case for $410 million. TD Bank paid roughly $62 million. The lawsuits didn't just win money back. They pushed a real share of the industry away from high-to-low reordering entirely, which is the one piece of this story where legal pressure, not a federal rule, produced a lasting change. The second practice is subtler and harder to sue over: the authorization hold. When you swipe your card, your bank often approves the purchase immediately, based on your balance at that exact moment. But the transaction doesn't actually settle for 1 to 3 days. If other charges post in the meantime, and your balance drops below zero before that original purchase settles, some banks will still charge an overdraft fee on a purchase that was fully covered by your balance the moment you made it. You did nothing wrong at the time of purchase. The fee shows up anyway, days later, for a decision the bank already approved. Pillar 3. Who actually pays for all of this? Because it isn't evenly distributed, and that's not an accident of bad luck. According to CFPB research, roughly 1/4 of households pay an overdraft fee in a given year, meaning 3/4 of Americans essentially never encounter this fee at all. Of the quarter who do pay it, the burden isn't spread evenly either. The same CFPB data finds these fees fall disproportionately on lower-income households and disproportionately on Black and other non-white households specifically. This isn't really a story about occasional bad luck with your bank balance. A cushion of even a few $100 extra sitting in an account is usually enough to never trigger this fee at all, which means overdraft revenue functions in practice as a fee paid overwhelmingly by people who don't have that cushion to begin with. And for some of those customers, one overdraft fee isn't even where it ends. A number of banks charge what's called a sustained or extended overdraft fee, an additional charge, sometimes daily, for every day an account remains negative, on top of the original fee for going negative in the first place. A single negative balance that isn't resolved quickly can generate charges day after day, compounding the exact problem it was meant to penalize. The households paying the most in overdraft fees tend to be the same households who could least afford an unexpected $27 to $35 charge in the first place, let alone a second one arriving daily until the balance recovers. So, 3 pillars. The regulatory whiplash, a rule that was supposed to cut this fee to $5, killed by Congress before it ever applied to a single transaction, after 5 years of voluntary progress that had nothing to do with any binding law. Transaction reordering and authorization holds, 2 distinct ways the timing and sequencing of your own transactions, not your actual spending, can multiply a single overdraft into several, which has already cost the industry hundreds of millions in settlements even where the underlying practices haven't been fully eliminated. And concentration, a fee that 3/4 of households never pay at all, collected overwhelmingly from the quarter who can least afford it, sometimes compounding daily until the balance recovers. None of this requires assuming bad intent at every single bank. It requires noticing that every time outside pressure eased, congressional, competitive, or legal, a meaningful share of this revenue came back, and that the customers most exposed to it were rarely the ones setting the terms of the conversation in Washington. If this made one more part of your bank account a little less invisible, that's what this channel is for. Money, explained with the receipts on screen, not your vibes. Next video, we're looking at one of the most profitable products most people don't think of as a financial product at all: insurance, and exactly how a company makes money on you even when you never file a single claim. Subscribe so you don't miss it. See you there.